If you're 45 and you've ever clicked on a video titled something like How a 25-year-old Builds a $1 Million Dividend Portfolio, you probably know exactly how it feels. You watch for a few minutes and start thinking, well, that's great for them, but I missed my chance. It feels like the math only works if you started decades ago, but that's not actually true. And instead of asking you to just take my word for it, let's compare two real-life situations. Meet Gary. He's 45. Then there's Curtis. Curtis started buying dividend stocks when he was 30, and for the past 15 years, every conversation somehow circles back to it. Not in an arrogant way. He just casually mentions things like, I'm glad I started early. I don't really have to think about it anymore. Gary has heard every version of the traditional advice. Buy low-yield dividend growth stocks. Reinvest every dividend. Be patient. Give it 30 years. So he tried doing exactly that. The problem? It isn't producing the results he expected. And that's because nobody ever told him something important. The strategy that works for Curtis isn't failing Gary because Gary started late. It's failing because Gary is solving a completely different problem. The Start at 30 playbook was written for someone with a completely different timeline. If you're 45, you shouldn't expect the same strategy to give you the same outcome. Over the next few minutes, I'll show you the one number that's more important than your age, the tax advantage most people in their 40s don't even realize exists, and why simply working harder to make up for lost time can quietly become one of the least effective ways to catch up. Then we'll put real numbers behind everything and see exactly what happened when Gary stopped following Curtis's rules and started using his own. Let's begin with something almost everyone assumes. I'll just make bigger retirement contributions once I'm old enough for catch-up contributions. Sounds reasonable. There's just one problem. If you're 45, you're not eligible yet. Catch-up contributions don't begin until age 50. For 2026, the IRS allows the same standard contribution limits whether you're 25 or 45. That means a 401k limit of $24,500 and a Roth IRA or traditional IRA limit of $7,500. No bonus, no extra room, nothing. So if you're 45, you're sitting in a 5-year window where the tax code doesn't give you any additional space to accelerate your savings. And here's what's interesting. Most advice aimed at late starters quietly assumes you're already past that point. But this isn't bad news. It's actually the key to looking at the problem differently. If retirement account limits aren't going to rescue you yet, then retirement accounts were never the real lever in the first place. What matters much more is what you own inside those accounts. And that's exactly where Gary's strategy should start looking very different from Curtis's. Curtis built his portfolio around time. Buying lower yield dividend growers made perfect sense because he had more than 3 decades for those dividends to grow. Gary doesn't. He has a much shorter runway. And that one difference should change what he's buying, not simply how much he's investing. Before we decide whether that's a problem, though, we need to know exactly how much time we're actually working with. Fortunately, that's easy to calculate. I call it your runway. Take 65 and subtract your current age. If you're 45, your runway is 20 years. Curtis started investing at 30, so his runway was 35 years. That isn't just a small difference. It's the difference between two investment strategies that technically fall under dividend investing, but operate very differently in practice. With a 35-year runway, a stock yielding 2% today can still become an incredible income producer because dividend growth has decades to compound. With only 20 years, that same company may still grow nicely, but it simply doesn't have enough time to reach its full potential before you actually need the income. The math didn't stop working. The clock just got shorter. And when the clock changes, the strategy has to change too. That's where the runway rule comes in. The less time you have, the more your future income needs to come from what your portfolio pays today, not from what it might pay 30 years from now. In other words, a shorter runway often means placing more emphasis on higher current yield instead of waiting decades for dividend growth to do all the heavy lifting. Now let's put some numbers behind this. Instead of $10,000 at age 30 into a stock yielding 2%. That gives him $200 a year in dividend income to start. Now assume that dividend grows by 8% annually. That's a strong but still realistic long-term dividend growth rate. Fast forward 20 years. By the time Curtis turns 50, that same $10,000 investment is generating roughly $930 a year in dividends, simply because the payout kept growing over time. Now let's look at Gary. He invests the same $10,000, but at age 45. Instead of choosing a 2% yielder, he buys an investment yielding 4% today, double the starting income, but with a slower dividend growth rate of around 5% per year, which is fairly typical for higher yield investments. 20 years later, Gary is 65. That same $10,000 investment is now producing roughly $1,060 a year in dividend income. Think about what just happened. Over the exact same 20-year period, Gary's slower growing, higher yield investment actually produces more annual income than Curtis's faster growing, lower yield investment. That doesn't mean high yield always wins. It doesn't. Dividend growth isn't guaranteed, and neither is yield. The point is that time changes which variable matters most. When your investing horizon is shorter, your starting yield carries much more of the workload than your dividend growth rate. That's exactly why the Runway rule exists. It's designed to match your strategy to the amount of time you actually have, not the amount of time you wish you had. This is where the tax code actually gives Gary an advantage that Curtis barely had to think about. Real estate investment trusts, or REITs, generally pay much higher current yields than the average dividend stock. According to the latest data from Nareit, the FTSE Nareit All Equity REITs Index currently yields around 3.69%, while the S&P 500 yields closer to 1%. Of course, there's a catch. REIT dividends usually aren't taxed like qualified dividends. Instead, they're generally taxed as ordinary income. That's the part everyone talks about. But what many people still don't realize is that Congress permanently addressed part of that issue. Under the One Big Beautiful Bill Act, signed into law in July 2025, Section 1990A allows eligible investors to deduct 20% of qualified REIT dividends before paying federal income tax on them. And unlike before, that deduction no longer has an expiration date. That's a meaningful benefit. It's not some obscure loophole. It's a permanent part of the tax code that specifically helps investors generating income today instead of waiting decades for future dividend growth. Curtis, investing at 30, didn't really need to think much about maximizing current income. Gary does. And surprisingly, many investors in their 40s and 50s still don't know this deduction even exists. So that's one important lever. But there's another one that's even more overlooked. In fact, it quietly costs many late starters far more money than they ever realize. Most people who reach their mid-40s have the same instinct. I'll just work harder. I'll earn more. A bigger paycheck will make up the difference. That's a perfectly reasonable way to think. The problem is that, after a certain point, extra income doesn't always produce the return people expect. And one of the clearest examples is Social Security. Your future Social Security benefit is based on your highest 35 years of earnings. Those earnings are plugged into a formula that uses what the Social Security Administration calls bend points. For someone becoming eligible at age 62 in 2026, the formula replaces 90% of the first $1,286 of average monthly earnings. It then replaces 32% of the next portion of income up to $7,749 per month. After that, only 15%. That's worth thinking about. If your career average earnings are already above roughly $93,000 a year, every additional dollar you earn only increases your future monthly Social Security benefit by about 15 cents. That's the entire return the formula gives you. Now, to be fair, if your lifetime average earnings are still below that threshold, then additional income absolutely does matter. You're still in the 32% replacement range, so raises and promotions can meaningfully increase your future benefit. So this isn't an argument beyond a certain income level, the payoff from earning more begins to shrink. Now compare that with what happens when you buy a dividend-paying investment instead. Every dollar you invest starts generating income, year after year. That income can grow over time. You still own the asset. You can sell it if you need the money, reinvest the dividends, or eventually leave it to your children. And unlike Social Security, there's no point where the income suddenly stops becoming worthwhile because you've crossed an earnings threshold. This isn't an argument against working hard. Keep pursuing raises if they make sense for your career. The point is that, at this stage of life, every extra hour you spend chasing a slightly bigger paycheck isn't always the highest return use of your effort. Sometimes, that same dollar invested into income-producing assets does more for your long-term financial future. Curtis didn't really have to think about that trade-off. At 30, he had decades ahead of him, so either path could work. At 45, your timeline is shorter, which makes these decisions matter much sooner. Now let's talk about the 4 biggest mistakes people make when they try to follow Curtis's strategy, instead of building one that actually fits where they are today. Mistake number 1. Buying ultra-low-yield dividend growers simply because someone online said that's what real dividend investors do. There's nothing wrong with high-quality dividend growth stocks. The problem is buying them without asking whether you still have enough runway for that strategy to fully play out. With a 35-year investing horizon, a 2% starting yield can eventually grow into a fantastic income stream. With only 20 years, that same investment may never have enough time to become the income producer you're counting on. And by the time you realize it, you've already spent years following a strategy that wasn't designed for your timeline. Mistake number 2. Avoiding REITs because you've heard they're taxed too heavily. That's one of those ideas that keeps getting repeated long after the rules have changed. Yes, REIT dividends are generally taxed as ordinary income, but many investors still don't know about the permanent Section 1990A deduction. Ignoring REITs without understanding the current tax rules could mean walking away from a legitimate tax advantage that Congress intentionally left in place. A lot of articles and videos online were created before that change became permanent. Unfortunately, outdated advice has a way of sticking around. Mistake number 3. Assuming catch-up contributions will eventually solve everything. People tell themselves, I'll really start getting serious once I turn 50. The problem is that those 5 years between 45 and 50 are incredibly valuable. You can't go back and recover 5 years of dividend payments, you can't recover 5 years of compounding, and you certainly can't recover 5 years of building an income stream that could already be working for you. Instead of waiting for larger retirement account contribution limits, those years can be used to steadily build taxable investments that begin generating income right away. Mistake number 4. Believing the only way to catch up is by working more. Again, there's absolutely nothing wrong with earning a promotion or negotiating a raise. But if you've already reached the part of the Social Security formula where additional earnings produce relatively small increases in future benefits, it's worth asking yourself a simple question. Where does the next dollar create the most value? Is it another hour at work? Or is it another dollar invested into assets that can continue paying you year after year? That's a calculation very few people ever make. Now let's make all of this more practical, because numbers only become useful when you can compare them to your own situation. Let's look at 3 different starting points. Suppose you're 45 and already have $50,000 invested. Instead of following the traditional low-yield growth strategy, your portfolio is positioned around a blended 4% current yield. That immediately produces about $2,000 a year in dividend income. From there, your income can continue growing through reinvestment, new contributor dividend, not because you're waiting another 35 years for the math to finally work. Now imagine you've already accumulated $150,000. At the same blended 4% yield, you're generating roughly $6,000 a year in dividend income from day one. That's before adding another dollar. If your portfolio has reached $300,000, that same 4% yield translates to approximately $12,000 a year in annual income immediately. Notice something important. None of these examples represent the finish line. They're simply your starting point. They're the foundation you're building from today, not some projection decades into the future. And because the strategy is designed around the time you actually have left, each of those portfolios begins producing meaningful income much sooner than a traditional start at 30 approach would at the same portfolio value. The principle stays exactly the same no matter which example looks most like your own situation. Right now, the mix of investments inside your portfolio matters more than the size of the portfolio itself, because that mix determines how much income shows up while you can still use it, not decades after you needed it. So how can you tell whether your portfolio is actually built for your timeline, or whether it's still following rules that were designed for someone who started 15 years earlier? There's one simple metric that can give you the answer. I call it the 45 rule. Here's how it works. First, calculate your dividend freedom number. Take the amount of monthly income you'd like your portfolio to generate and multiply it by 200. That gives you a rough estimate of the portfolio value you'd need, assuming a blended yield of around 6%. Next, look at your portfolio as it exists today, not what you hope it'll yield someday, not what an online calculator projects 30 years from now. What does it actually yield right now? If your runway is less than 20 years and your current portfolio yield is still below 4%, there's a good chance you're using a strategy built for someone with a much longer investing horizon. That isn't a reason to panic. It doesn't mean you've made a mistake. It simply tells you your portfolio may need a different emphasis going forward. Maybe that means gradually adding more higher yield holdings. Maybe it means allocating a portion to REITs to boost current income while taking advantage of the Section 1990A deduction we talked about earlier. The exact solution depends on your goals. The important part is understanding what your current numbers are telling you, instead of blindly following someone else's roadmap. If you'd rather not calculate all of that yourself, I've linked a free dividend snowball calculator in the description. Just enter your age and your target monthly income, and it'll calculate both your runway and your dividend freedom number automatically. It gives you a much clearer picture of where you stand and how far you really are from your goal. Before we wrap up, let's quickly review the biggest takeaways. First, there's what I call the 45 gap. Catch-up retirement contributions don't begin until age 50. So if you're 45, retirement account limits aren't going to help you accelerate just yet. That means what you invest in matters far more than simply which account you're using. Second, there's the runway rule. Take 65 and subtract your current age. That number tells you how much time your portfolio has left to work for you. The shorter your runway, the more important current income becomes relative to long-term dividend growth. That's exactly why investments like REITs and the permanent Section 1990A deduction that supports them deserve a closer look for many investors in this stage of life. Third, don't overlook the bend point blind spot. Beyond certain income levels, every extra dollar you earn adds surprisingly little to your future Social Security benefit. Meanwhile, every dollar invested into income-producing assets continues working for you, year after year, without running into that same limitation. And finally, there's the 45 rule itself. Compare your dividend freedom number with what your portfolio actually yields today. That comparison gives you a much clearer picture of whether your investment strategy matches your remaining investing timeline. Now let's go back to Gary. Once he ran the numbers, everything clicked. He had a 20-year runway. His portfolio was yielding less than 3%. Almost everything he owned consisted of low-yield dividend growth stocks he'd bought because he was trying to copy Curtis. The problem wasn't that he had started too late. The problem was that he was using someone else's blueprint. So instead of selling everything and starting over, he made a much smarter adjustment. He kept the quality dividend growers he already owned. He directed all of his new money toward investments with stronger current income, including REITs. He stopped comparing his 20-year journey to someone else's 35-year head start. Curtis still likes reminding everyone that he started investing at 30. These days, Gary just smiles, because he finally understands something Curtis never had to learn. You don't need more years. You need the right strategy for the years you actually have. If you want to see exactly how much money you need to replace your paycheck with dividend income, not just build a portfolio but actually live off it, watch the next video, How to Live Off Dividends. Starting at your 40s or 50s, you're not late. In that video, we break down the actual numbers and show you what it takes to turn a dividend portfolio into real retirement income. And before you go, I'd love to hear from you. What's your runway? Just take 65 minus your age and let me know in the comments. Also tell me whether your portfolio's current yield is above or below 4%. I'm curious to see how many of you are actually much closer to financial independence than you think.